How many times have you heard someone say, oh, if only I bought that stock back then, or maybe I just don't know how to pick a winner?
Yeah, happens all the time.
It's easy to feel like the stock market is this mysterious beast, right?
Mm.
Especially after big financial downturns. But what if there was a systematic way, like a battle-tested blueprint, to consistently make money in stocks?
Well, what's fascinating here is that William O'Neill, who's the subject of our deep dive today, he believed exactly that. His book, How to Make Money in Stocks, first hit shelves back in 2009.
2009, right after the financial crisis when everything was tumbling.
Exactly. And yet, it went on to sell an incredible 2 million copies.
Wow, 2 million copies right after a meltdown. That really says something.
Okay.
So our mission today is basically to unpack O'Neill's investment philosophy. It's built on, what, over 125 years of research into the best stocks?
That's right, a massive study.
And we're going to get into his specific actionable strategies selecting, buying, selling stocks. And what really stands out, I think, is that O'Neill, kind of contrary to some common advice, fully embraced market timing, trading, and reading stock charts.
He did. He didn't see them as just, gambling tools. He saw them as essential navigation instruments.
Like crucial insights into supply and demand that maybe you miss with just the fundamentals.
Precisely. He built his whole system around using them effectively.
Okay, so let's unpack this core system then. Where do we even begin when trying to spot potential winners, according to O'Neill?
We start with the heart of his process, the CAN-SLIM system. It's an acronym, and each letter stands for a key characteristic that these great winning stocks showed in their early high-growth stages, right before they really took off.
CAN-SLIM, okay. And the C stands for?
C is for current quarterly earnings and sales. O'Neill found this was, like, the most prominent trait among the big winners.
Okay, the most prominent. So what exactly was he looking for there? Big numbers.
Yeah, a major increase in current quarterly earnings per share compared to the same quarter last year. His research showed, get this, 3 out of 4 winning stocks had an average jump of 70%.
70%.
Yeah, but the minimum threshold he looked for was 20%. It's not just a number, though. It points to companies hitting some kind of inflection point, maybe a surge in demand, a breakthrough, something the market hasn't quite grasped yet.
I see. And sales too.
Oh yeah, sales should show similar strong increases. Accelerating growth is even better.
Right, showing real momentum. Okay, so that's the C. What about the A in CAN-SLIM?
The A, which is annual earnings increase, is basically there to make sure that latest quarter isn't just a one-off, a fluke.
Checks for consistency.
Exactly. You
Yeah.
want consistency. O'Neill suggested looking for at least 25% average annual earnings growth per share over the last 3 years. It really helps confirm, the company's longer-term growth path.
Makes sense. But then there's the N, new products, management, or conditions. O'Neill thought something genuinely new was fundamental for big stock moves. Why was that so important for him?
Well, it makes perfect sense when you think about it, doesn't it? Truly exceptional growth, the kind that makes a stock a superstar, rarely comes from just business as usual.
Right, you need a catalyst.
You need innovation or some kind of paradigm shift. It could be a groundbreaking product that crushes competitors or even creates a whole new market. Or maybe it's a new CEO shaking things up, bringing in a fresh strategy.
Or even broader industry changes.
Absolutely. Things like supply shortages, maybe the impact of war or some disruptive new technology suddenly emerging. And the stat here is just astonishing. 95% of the market superstars over the last century fell into one of these new categories.
95%, that's huge. So these aren't just companies doing okay, they're companies in transformation. Okay, S is for supply and demand. How does that basic economic principle apply specifically to stocks in O'Neill's view?
Well, whether it's the latest gadget or rare art supply and demand rule, and for stocks, it's the same game. You want to look for companies that are actively reducing their own stock supply.
How do they do that? Buybacks.
Exactly, share buyback programs. That shrinks the available pool. And on the demand side, it's a really strong signal if the top management are significant shareholders themselves.
Putting their money where their mouth is.
Precisely. It shows they believe in the company's prospects, aligns their interests with ours.
Yeah, that's a powerful signal. Okay, then we get to L, leader or laggard. This one feels pretty straightforward. Buy the leaders, avoid the stragglers. But how did O'Neill define a leader?
He was very clear on this. Aim for the number 1 or number 2 company within a strong industry group. These leaders, they stand out because they have better quarterly and annual earnings growth than their competitors.
So focus on the best performers in the best sectors.
Right. It's about putting your capital on the strongest horses in the race, not hoping some struggling company will magically turn around. You know that old saying, the first man gets the oyster, the second gets the shell.
You want the oyster. Got it. Okay, moving to institutional sponsorship. Why the focus on big institutions?
Well, they're the elephant in the room, right? Institutional investors, pension funds, mutual funds, hedge funds, they're the biggest source of demand in the market. They control huge amounts of capital.
So you want them on your side?
Definitely. You want to look for companies that already have institutional owners. And O'Neill specifically like to see some ownership by top-performing asset management firms. Even better if the number of institutions owning the stock has increased recently.
Why is that increase important?
Because it implies that when these big funds start building a position, they often add to it over time. That buying pressure can really drive the price up. It's like professional validation.
Okay, makes sense. And finally, the M in CanSlim is market direction. O'Neill said you can nail all 6 other factors perfectly.
But if you get the overall market direction wrong, you're probably still going to lose money.
Why did he stress that so much? It seems almost fatalistic.
Because, a rising tide lifts all boats, but a falling tide sinks nearly all of them. Even the best stock pick can get hammered in a bear market. O'Neill thought this was so critical, it really deserves its own, deeper look.
Okay, let's take that deeper look then. How can an investor, figure out the market's direction? And why is it so crucial strategically?
Well, it dictates your whole game plan, basically. In bull markets, you want to be fully invested. O'Neill even suggested potentially using some borrowing leverage to maximize gains.
Okay, and in bear markets?
Opposites. You absolutely want to hold cash, get out, protect your capital. The best clues about which way the tide is turning come from watching the major market averages their price action and, importantly, their trading volume.
Right, like the S&P 500, the NASDAQ, maybe relevant international or local indices depending on where your stock trades?
Exactly. You need to follow the index most relevant to the stocks you own or are watching, say, the NASDAQ for a U.S. tech company. And these indices, they have telltale behaviors.
Like what? How do bull and bear markets look different day to day in the indices?
Generally, in bear markets, stocks might open strong, seem hopeful, but then they tend to close weak near their lows for the day. It shows underlying selling pressure keeps emerging.
And bull markets?
They often do the opposite. Maybe a weaker open, but they gather strength and close strong. It shows buyers are stepping in throughout the day.
Okay, so daily patterns. But how do you spot the big turning points? When a bull market might be ending, or a bear market finally bottoming out, what are O'Neill's signals for that?
Good question. A bull market top often forms after you see maybe 4 or 5 distribution days spread over 4 or 5 weeks.
Distribution days, what's that?
A distribution day is when a major index closes down or maybe flat, but on higher trading volume than the previous day. Or it could close up slightly, but on massive volume, showing lots of churning. It suggests institutions are selling heavily into the buying interest, quietly unloading shares.
Heavy selling masked by activity. Got it. And the turn from bear to bull, what does that look like?
That's usually signaled differently. Typically, a bear market ends when an index tries to rally for, say, 3 to 6 days. Then, somewhere between the 4th and 7th day of that attempted rally, you get what O'Neill called a follow-through day.
Okay, what constitutes an attempted rally and a follow-through?
An attempted rally is just the index closing higher than the day before, or maybe recovering from a morning drop to close higher. It shows some buying interest is returning. But the follow-through is the key confirmation. That's a day where the index price jumps up distinctly. O'Neill liked to see maybe 2% or more, and importantly, it happens on increased daily trading volume compared to recent days.
So a strong up day on higher volume, after a few days of trying to lift off the bottom, that's the signal.
That's the classic signal, yeah. It shows new institutional buying is coming in with conviction.
And isn't there that sort of counterintuitive thing O'Neill mentioned about when the news is worst?
Oh, yeah, absolutely. The shift from bear to bull often happens precisely when the newspapers and media are painting this, pitch black future for the economy.
Yeah.
Things feel terrible, but that's often when the market quietly bottoms.
So trust the market action, not the headlines.
Exactly. And he had a simple personal check, too. Look at your last 4 or 5 stock purchases. If they're all nicely in profit, chances are you're in a bull market. If none of them have made you a dime, you're probably fighting a bear market.
That's a practical check.
Yeah.
And the more indices showing these bull or bear signals, the stronger the confirmation, right?
Definitely. The more confirmation you get across different major indices, the higher the probability the signal is real.
Okay, so let's say you've determined the market is likely in your favor. It's a bull market. And you found a stock that passes the canned slim test. How do you pinpoint the exact moment to buy? This is where O'Neill's chart patterns come in, right? He saw them as diagnostic tools.
That's a great analogy, yeah. Like a doctor uses an EKG or a scientist uses weather models. For O'Neill, the stock's price and volume patterns, shown on a chart, are your primary source of information about its health. These patterns form bases, some are strong and healthy, others are weak and flawed.
And his team studied countless charts of winning stocks. Did one pattern stand out as particularly reliable or profitable?
Yes, absolutely. The one they found most often before huge price gains was the cup with handle pattern.
Cup with handle. Okay, visually, I guess it looks like a teacup.
Exactly, viewed from the side. Let's break it down. The cup part is the base itself. It typically forms over 7 to 65 weeks, so it takes time.
Right. And how deep should the cup be?
The depth, meaning the decline from the peak before it starts turning back up, is usually around 12% to 30%. It can be deeper, maybe 40% or 50%, especially if there was a general market correction happening at the same time.
Okay. And the shape matters.
Hugely. O'Neill strongly preferred a U-shape, like a rounded bottom, not a sharp V-shape.
Why the U-shape?
Because that longer, flatter bottom part tends to shake out the impatient, weak investors. It builds a more solid foundation of committed holders who are less likely to sell quickly on the next move up. It's a natural consolidation.
Okay, a gradual bottoming is better. So that's the cup. What about the handle?
Right, after the stock price comes back up the right side of the cup, nearing its old high, it often pulls back slightly, forming the handle. This handle should ideally form in the upper half of the overall cup pattern.
Upper half, okay. And what does the handle look like?
It usually drifts downwards slightly in price on lower volume. It's one last little shakeout, getting rid of the last few nervous sellers before the potential breakout. Crucially, the low of the handle shouldn't dip below the stock's 10-week moving average price line, and it typically needs to last for at least a week or two, often longer.
So a slight downward drift in the top half of the cup above the moving average.
Yeah.
And then comes the buying point.
Exactly. After the handle forms, you're looking for the pivot point or buy point. This term actually comes from the legendary trader Jesse Livermore. It's the moment the stock breaks out of that handle's downward trend line.
And what confirms the breakout?
Volume. Massive volume increase. You want to see daily trading volume surge by at least 40–50% above its recent average as it breaks that pivot point. But O'Neill noted that real new market leaders, the explosive ones, can show volume increases of 200%, 500%, even 1,000% on that breakout day.
Wow, that's a huge flag saying institutions are piling in.
Absolutely undeniable institutional buying. And there are a couple more subtle signs of strength within the base. Look for tightness a few weeks where the price closes very close to its weekly low, showing controlled action. And look for volume to really dry up at the very bottom of the cup and during the handle formation.
Drying volume means?
It signifies that the selling pressure is exhausted. There are just fewer shares available for sale down there. Oh, and one more crucial thing. O'Neill always wanted to see the stock already up at least 30% before this whole cup pattern even started forming, ideally with volume picking up during that initial rise.
So it's already shown leadership before it consolidates.
Exactly. You're buying strength on the way up after a proper consolidation.
Okay, so that's a very specific, almost choreographed pattern on the chart, telling a story of decline, stabilization, shakeouts, and then that explosive volume-confirmed breakout. It's quite detailed. And while the cup with handle was his favorite, did he mention other useful base patterns?
He did, yeah. He also discussed patterns like the cup without a handle, the double bottom, which looks like a W, and the flat base, which is more of a sideways consolidation. They're also valuable, just maybe less common than the cup with handle among the biggest winners.
Right. Okay, so you've done your Can Slim homework, you've judged the market direction, you've found a stock breaking out from a strong base like a cup with handle, and you've bought it at the pivot point. Now what? O'Neill had one absolute ironclad rule for selling, didn't he? About cutting losses.
Oh, yes, the golden rule. And it's something so many investors struggle with emotionally.
Definitely. What was his core philosophy there?
It was simple and direct. The best offense is a strong defense. He argued that winning big in stocks isn't really about being right all the time. Nobody is. It's about losing the least amount possible when you're inevitably wrong.
Makes sense. So what's the rule?
Cut every single loss short at a 7% or 8% decline from your purchase price. period.
7 or 8%, that's it.
Yeah, that's it. And the key part, O'Neill stressed. And no exceptions. None. Don't wait a few days hoping it bounces back. Don't wait for the market to close. Don't rationalize. The rule is triggered. You sell immediately.
Wow, no exceptions. That's incredibly disciplined. Almost feels ruthless. But the math really backs it up, doesn't it?
It absolutely does. People forget how hard it is to recover from losses. If you lose 20%, you need a 25% gain just to get back to even. Lose 33%, you need a 50% gain. And if you let a stock drop 50%, well, you need a 100% gain, a double, just to break even.
Ouch. The longer you wait, the more the math just crushes you.
Exactly. Cutting losses small and fast is just non-negotiable capital preservation. It keeps you in the game.
So if you're disciplined about buying canned slim stocks, breaking out of strong bases, and you're ruthless about that 7-8% stop loss, hopefully you won't be taking too many losses, which shifts the focus.
To the more pleasant problem, when you sell your winners and take profits.
Right, the fun part. But that can be tricky too, psychologically. Holding on too long, letting big gains evaporate. Before we get into O'Neill's specific signals for taking gains, can you share that famous turkey story? I think it really nails the trap people fall into.
It does. It's a classic. So the story goes, there's this man trying to catch wild turkeys. He builds a trap, basically a big box propped up with a stick, and he lays a trail of corn leading under it. The plan is wait till enough turkeys are under the box, then pull the string tied to the stick, the box falls, and he catches them. But he only gets one shot.
Okay, sounds like a plan.
So he waits. At one point, he counts 12 turkeys under the box. He thinks, great. But just as he's about to pull the string, one turkey wanders out. Now there are 11. He thinks, darn, I should have pulled it when there were 12. Maybe that one will come back.
Uh-oh. I see where this is going.
Yeah. While he's waiting for the 12th turkey to return, 2 more wander out. Now there are 9. He thinks, oh man, I would have been happy with 11. Now I only have 9. He waits a bit longer. 3 more leave. Now there are only 6. The man, having seen 12 under there earlier, just can't bring himself to settle for only 6. He keeps waiting, hoping more will come back.
Right.
And eventually, they all wander off. The box is empty. He goes home with nothing.
Oof. That's painful.
And the moral?
The moral is crystal clear for investors. You must have a plan for taking your profits. Don't get greedy waiting for the absolute peak or hoping a stock gets back to its old high after it starts falling. Be realistic, be humble, follow your selling rules, or you risk giving it all back just like the man with the turkeys.
Powerful story. It really highlights that greed and hope trap. Okay, so O'Neill didn't want us coming home empty-handed. What were his specific situations or signals for considering selling a winning stock?
He outlined quite a few, based again on chart patterns and stock behavior. First, watch for signs of distribution at the top, like the distribution days we talked about for market tops.
Similar idea, but for an individual stock. After a long price run-up, if you see days with heavy trading volume but the stock makes little or no further price progress, or even closes down, that's institutions selling into strength. A few days like that in a short period is a major red flag. Sell time.
Okay, heavy volume, but no progress. Got it. What's next?
Second, watch out after a stock split. If a stock surges, say, 25% or more within just the first couple of weeks after splitting, O'Neill found that's usually an excessive, unsustainable gain driven by uninformed public buying. Often a good time to sell.
Interesting. Number 3.
Third, the upper channel line. If you draw a line connecting the peaks of a stock's price over the last, say, 4 or 5 months, that forms an upper channel line. If the stock, after a long run, suddenly surges way above that line, it's often climactic and overextended, usually a place to sell.
Okay, piercing its upper boundary. Fourth.
Fourth, new highs on poor volume. This is the opposite of the breakout signal. If a stock keeps drifting to new price highs, but the trading volume is drying up, getting lighter and lighter, that's a sign of weakness. It means conviction is fading, fewer buyers are participating. Consider selling.
Right, lack of enthusiastic buying. Fifth,
poor relative strength. If your stock starts lagging behind its industry group or the general market index, even if it's not dropping much, it's showing relative weakness, good stocks lead. If yours stops leading, it might be time to sell and find one that is.
makes sense. Leaders lead. Sixth,
Beware the Lone Ranger stock. If your stock is the only one in its entire industry group that's still managing to advance while all its peers are weakening, that's usually not a sign that your company is invincible. It more often means the whole industry is facing headwinds and your stock is likely the next domino to fall.
the last man standing often isn't standing for long. Okay, seventh.
Seventh, watch how the stock closes each day. If it repeatedly closes at or very near its lowest price for the day, even if it was up earlier, that's a persistent sign of selling pressure taking over by the end of the session. Watch out.
Consistent weak closes.
Eighth. Eighth is a fundamental signal, slowing earnings growth. If the company's quarterly earnings increases, which got you interested in the first place via the C and A in CanSlim, start to decelerate significantly for 2 or more consecutive quarters, the growth story might be fading. That's a solid reason to sell.
The fundamentals are changing. And finally, ninth.
And ninth, simply selling all the way back down again. You just shouldn't let a stock give back too much of its gain from the peak. O'Neill didn't give a hard and fast rule here, but generally if a stock falls more than, say, 12–15% from its ultimate high point, you should probably be selling it. Ideally, though, one of the other 8 sell signals would have gotten you out even earlier, closer to the top.
Right, those other signals are often earlier warnings. Wow, that's a pretty comprehensive set of sell rules, both for cutting losses and taking profits. It really paints a picture of a very disciplined, unemotional approach.
Exactly. Rules-based, data-driven.
So let's try to boil this all down for the listeners. What are the absolute core lessons we should take away from O'Neill's How to Make Money in Stocks that we've unpacked today?
Okay, I'd say 5 key things. First, always use the CanSlim test or something similarly rigorous to screen potential stocks before you even think about buying.
Right, filter first.
Second, you need reliable tools and methods to judge the overall market direction. Knowing if you're in a bull or bear market is absolutely crucial for deciding whether to be invested and how aggressively.
Market context is king. Third,
Don't just buy stocks that pass CanSlim. Look for those that are also emerging from strong, sound-based patterns, like the cup with handle. That's where the high probability entry points are.
buy from strong foundations. Fourth,
Fourth, the non-negotiable. Cut every loss at 7% or 8% from your purchase price. No exceptions. Protect your capital above all else.
defense first. And fifth,
And fifth, don't be the turkey guy. Develop a clear, systematic plan for when to take your profits, using signals like the ones O'Neill identified. Lock in those gains. Don't let them evaporate.
okay, that's a solid 5-point summary. O'Neill left readers with a powerful final piece of advice too, didn't he? About what it really takes.
He did. He really emphasized that it's the consistent study, the learning time, the homework you put in after your regular 9-to-5 job, Monday through Friday evenings, weekends. That is what ultimately separates the winners from the losers.
So it's about continuous effort and learning.
He truly believed the market rewards diligent, systematic preparation. That's how you spot those life-changing opportunities.
A great final thought from O'Neill. So maybe a final thought for you, our listeners, to ponder. Given O'Neill's incredibly rigorous, rule-based system for tackling the complexities of the stock market, what's one area in your own life, completely outside of investing, where maybe applying a similar kind of systematic review or rule-based approach might unlock some surprising insights, or maybe help you prevent some significant losses?
It's interesting, applying CanSlim thinking to life decisions.
Something to think about until our next deep dive.